Listeners often ask us, what stock should I buy? And this is a common question among beginner investors where they look to other people to get suggestions. Like some of my friends have asked me, should I just buy into an index fund or ETF or what should I get? And, I qualify that with saying, here's some education. And I don't tell them what to invest in, but because you know us, we just are all about education and hopefully some entertainment value, but we're not trying to tell you what you should invest in. So this is just for your learning purposes. So we hope you keep that in mind. But some of the things that I would say, if you want to have a few options to consider, is let's think about what some of the best investors say, like Warren Buffett and Charlie Munger. They say that most people, if you're not going to put a lot of time and effort into it, just get into some index funds. And if you believe in the future of America in general, like an S&P 500 index fund. And if you want to put more time and effort, like picking stocks, because there could have a potential of generating higher returns if you invest in companies that you believe in and which satisfy certain investing criteria, which we're going to reinforce in today's episode. So you're listening to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Signe Lundholt.
And you may be wondering, what are these principles that I should think about as I want to invest in stocks? And you heard us talk about in a recent episode about circle of competence. That's one of Buffett and Munger's core investing principles. And we'll reiterate some of the other three core principles you should keep in mind, like a moat, which is a company's durable competitive advantage, as well as management, like what are the CEO's decisions that they're making for the company. And then third is what's called a margin of safety. Are you buying this company at a price that makes sense? So those are some of the core Buffett principles we will focus on today. And Sina, where would you like to start off in answering the listener's question?
Well, I just want to touch on that as an investment mentor and having people contact me about this question, I get it quite a lot. So, for example, recently I was on a call with someone who potentially wanted to be a mentee. And during that conversation, and it's something that I've experienced many times, they're asking for advice on what they should invest in. And of course, I'm, not an investment advisor. I'm teaching them how to invest in stocks, and so they can do it on their own. And it's amazing to be a part of that process from, not knowing what they're doing, not understanding what they're doing, to understanding what they're actually doing. So that's just an amazing journey being a part of. But in this particular call, and that's what I experience sometimes. Then they start, first by asking, so what should I invest in right now? And then, as you say, I start, talking about education and what to look for. But then, the next thing that often happens is that they're going to start some, like, is it Nvidia? Is it like, what should I invest in right now? I've heard a lot about Nvidia. Or here in Denmark, it's a company that's called Novo Nordic that has a very, a range of very popular medical products, and it's a company that had great success over the years, and that's typically also a company that where people are looking at me and then they're trying to see my reaction towards when they say some of those company names, if they can spot whether or not I would invest in a business like that.
Yeah,
So
and I
it's
want to jump in
kind of funny.
because you're mentioning that company, and I think maybe people are so interested in Novo Nordisk because of Ozempic and all these amazing weight loss drugs that start out as diabetes drugs, and now it's a lot of hype in the pharmaceutical industry about this magical drug, which there's not even long-term research for people to know what are the long-term effects of people being on these drugs. So even though there's a lot of excitement and people are like, this is the magic pill everybody's been looking for years, but that could be a double-edged sword. So, people shouldn't just be rushing to jump into something like that, which is driven by a lot of popularity lately.
Yeah, and I 100% agree. We don't know what long term this will mean. We know that short term, if people don't continue taking the drug, that then they gain weight again. But we don't know what is actually happening in your body with this type of drug. So, anyways, it's a very, very popular, especially these days. It's been popular for years because before then, as you say, they were into diabetes drugs and very successful within that field, and they continue to kind of go into to other fields. It used to be primarily focused on diabetes, but now they kind of broadened their focus and objective to looking into many more lifestyle diseases. So it's a very popular company here in Denmark, and it's similar to Nvidia. It just had a lot of. It's always been popular, but these days it's extremely popular and people rushing into that stock. But the reason why we're also talking about this is because it's one of the questions that I get a lot of times, right? It's picking some of those momentum stocks, some of those very popular stocks, and looking at me if it's something that I would invest in. And again, I'm not in a advisory role. I can't make suggestions to them in my workshop. Of course, I have to give some educational examples of healthy businesses and sickly businesses, which is some of the things that Buffett talks about, whether the competitive advantage, what he calls moat, makes a company a winner. So it's some of those things that people will learn, but me not being an advisor and not having people pay for me suggesting stocks to them, I can't really do that. So and also what's in the core of what I teach people, and we're talking about here, Michelle, is that people can make those decisions on their own and actually have trust in in themselves once they have the tools on actually how to do it on their own. So staying within the circle of competence, management that it's talented and honest, and trying to, look to see on different numbers that will qualify that or not. And then again, the competitive advantage. And it's not about gut feelings and things like that. Of course, it's also about that. Like when I look at management, for example, I like to kind of get my own opinion by watching videos or listening to earnings calls or something like that, and then kind of get that stomach feeling about management. But for me, it's really the numbers. It's a numbers game, and it's looking towards, is this healthy or sickly? How about yourself? How do you qualify if something is a good investment?
Yeah, actually, that's a lot of uh, key points you mentioned there about moat and also management. So let's take some of these one by one of thinking through something. So even though I'm not invested in McDonald's, but last night I happened to watch The Founder again, where Michael Keaton was being the person Ray Kroc who basically made McDonald's into what it is today, this behemoth, incredible fast food company. And with McDonald's, one of their moats is a brand. Like he knew it instantly when in 1954 in San Bernardino, California, he came across this incredible, really popular, busy burger stand in California called McDonald's. And he was like, this name is just amazing. And, in the movie, you hear him say, no one would ever come to Croc's Burgers. Like, it doesn't sound like a good brand, like but when you hear McDonald's, it sounds wholesome, it sounds all American. They were able to start a brand and have a system that reinforced when you buy this McDonald's brand, you are getting quality, at least back then. I don't know about now, but like at least in the 50s, it meant you got this great quality tasting burger and they kept the menu simple and they kept it fast. Like instead of the drive-ins that were popular back then where you waited half an hour for someone on roller skates to bring you food, you now got a fresh hot burger in only 30 seconds, not 30 minutes. So it's incredible that Ray Kroc saw the potential of the revolutionary food making style that the McDonald's brothers came up with. And he was able to grow this model, scale it in such a way to have national appeal to the masses. So what he realized also was that he was in the business of real estate. So we think, okay, it started out as sort of a food business, like, making these great burgers, but the moat is actually the real estate that McDonald's owns as a corporation, and they lease it out to the franchisees, and the franchisees have to pay money to McDonald's as the real estate owner for the right to sell the burgers on that location. So it's fascinating how we think of McDonald's like, "Oh, we're getting fast food," but no, really, it's this incredible real estate business. So if you learn about that kind of moat, it's like a brand moat and also what's called a toll bridge moat because the franchisees can only sell McDonald's if they buy that special license from McDonald's as a company and a promise that they will follow all the quality standards that McDonald's has put upon them. So if you think about that, they have those two kinds of moats of toll bridge where they pay the fee in order to sell the goods, and it's a brand because in the minds of consumers, everybody's like, "Ba-da-ba-ba-ba, I'm loving it," right? Even though I don't personally love it, but they have put it in the mind of the people in America and internationally to be like, "Ooh, I want this burger."
If you want to read a book or listen to the book, I really recommend Americana, The Making of American Capitalism. I don't remember the author's name, but it's really a great book. I listened to it as an audiobook and highly recommend the book where you will learn about the story about McDonald's and how that, became a global brand, as well as many other businesses that are existing today and not existing today, but how the foundation of America was actually built on capitalism. It's a fantastic book. I cannot recommend it enough if you would like to know more about businesses in the United States. But yeah, it's a very, very good point in the mode and talking about mode, and you're talking about the toll bridge mode as well as the brand mode. Brand mode is something Buffett also calls a consumer monopoly, which is where they create raving fans that once those products, it sort of becomes a consumer monopoly. With Coca-Cola, for example, some people only wants to drink Coke or Pepsi, and they just go only towards that drink. If it's not on shelf, they go somewhere else to find it. Um, Another type of mode that we could be talking about is, and that's really, really a strong mode. It's the network or ecosystem mode, right? Where it's something like Apple and what if you have Apple products, what you probably know is that once you're in the ecosystem, it's very, very difficult to leave. You have all your, you paid for apps, you paid for maybe music, and once you're into Apple, it's very difficult to buy a phone that's with the Android operating system, because then you would have to start over. You'd have to start from scratch, and everything is kind of working seamlessly with Mac. So you're like, why would I buy a phone from the Android system when every product I have is working seamlessly together and it's just working? If Apple were to get threatened on their mode, it would have to be because it wouldn't be working, that we would start feeling, oh, these things aren't really working well, or I can't get the apps I need. It's only on Android if I want that app or something like that. And and we see with the latest product from Apple, the virtual reality goggles, that some companies like Netflix did want to create an app for those, specifically for those, so that the users of that product could get an fantastic experience with Netflix. What they said was, no, we're not going to create a special app for your device there. And we'll see if they have to cave in, if Netflix over time will have to cave in, or if Apple will have to cave in. We don't know about that, but the reviews so far have been great on those goggles, or whatever what to call them. I'm not even sure, but
Aren't those like $3,500, which is like 10 times more than what the Oculus from Meta Facebook is. Like it's
They're ridiculously expensive. I don't know
yeah.
what it is in dollars. I know what it
Mhm.
is in the Danish currency kroner, but I don't know. It's ridiculous. It's
Yeah,
a lot of money.
I just saw like I mean, it kind of reminds me of the old times when Apple computers used to be like several thousands of dollars compared to say a Microsoft PC in 1995 and it was like not so affordable but still like not even at the price point that a lot of Apple computers were. But anyway, we digress a little bit, but you get the point of
Can I say something more about, since we're talking about those goggles?
Mhm.
If you come across, some videos online, there's actually, starting to be some of those videos from, you know, s sidewalks and things like that where people are wearing the goggles and, pinching in the air and, and different kind of things, moving things in the air, wearing the goggles, but being outside, a cafe, sitting at a cafe. It looks so funny. And my fear is that society will be like that in the future, that we're all going to wear these goggles and sit there and burp, 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 and when we talk to each other, we're going to talk to the avatars. Man, it's scary,
it
scary
might have
stuff.
yeah, some applications for gaming, but also maybe there might be some actually societal beneficial uses for that. Like the not to go too deep into this topic because we want to talk about the other Buffett principles, but I went skiing not too long ago and I was impressed at how there were some folks who are blind or visually impaired and they were skiing with some guides. Maybe these VR or AR glasses could have the potential ability to help people who are skiers who cannot see that well, maybe be able to ski better down a mountain. And, even though now you have a guide saying you go left, go right, but for the visually impaired, maybe this kind of technology could help them ski on their own someday. Like that could be amazing. So I know we think about like the normal consumer, but it could be something that could potentially help those who need accessibility tools. So I'm looking forward to that. I hope that that will help people who are in need as well.
Yeah, 100%. So I talked a little bit about the network mode, and one of the things you can do in, when you find a stock that you would like to invest in is to look at the mode. Does the company have a strong mode? Michelle talked about brand and about being sort of a monopoly slash toll bridge. I talked about ecosystem. There's also, a mode where it's about secrets or proprietary processes or
Yeah, like pharmaceutical
technology.
companies. Yeah,
Hmm.
pharmaceutical companies have secrets, moats.
Yeah, absolutely. So it's something that you can look into. There's also 3M, which invented Post-its, is one of the things we know, but just a ton of different kind of chemicals and fabric types and all sorts of things that they have the intellectual property for and are the only ones that are allowed to actually, Tinsulet, for example, is allowed to use that for products. So you need to buy that from 3M as a, clothing company if you want Tinsulet for your products. So yeah, there's those different kinds of modes out there, and you can think about, okay, what, and mode being the competitive advantage, what kind of competitive advantage does my company have? It's one of the things that you could think of before buying a stock. What's some other things that you're looking for, Michelle?
Another thing I look for is management. Like I've learned from this author and friend of Warren Buffett named Laura Rittenhouse. She's got a lot of great books and learning materials out there of how you evaluate a CEO. Like when you read a CEO's letter, can you believe them and trust them? Do they speak with candor? So that's a very important criteria to analyze whether a CEO is being forthright with you, and you can measure a CEO both qualitatively in what they talk about in their letter as well as quantitatively with looking at metrics like how they're allocating capital. Like, are they allocating capital in terms of the money that they're putting toward either growth initiatives in the company, or are they buying back stock, or are they blowing up executive pay packages? Like, we recently heard about Elon Musk trying to get a nearly $56 billion pay package that got struck down. And, It's like incredible how some of these CEOs want to get paid a lot of money, and we can see, is that good for the benefit of the company? It probably was perceived not to be that good for the company because Tesla's share price has been suffering lately. So if shareholders see CEOs being a little too greedy, that can backfire if, say, CEO compensation is just going through the roof, like we've talked about in a recent podcast episode. And those are some things that we can look for. So, also how they're dealing with debt. Are they getting the debt to be more than 3 years worth of earnings? So, what we've learned from Phil Town and Rule One style investing is that uh, a CEO should not be racking up long-term debt that's more than 3 years worth of the company's earnings. So that should be a red flag if you see that in some companies. And I also mentioned return on invested capital. If you see that going up over time, that's a good marker of a CEO's performance. So those are some of the things. There's way more that you can judge a CEO's performance. What do you think about CEOs and how management makes decisions, Sina?
It's super important, but even, there's a lot of people buying stocks out there that don't even look at if the company comes out with a profit or a loss. And that's definitely something that you can check out in order to actually measure management, is to ensure that they came out with a profit and not a loss. So it's a basic measurement of seeing how the company is performing, and the least you could do before buying a stock is to just look at how healthy is it like that. There are, different kind of numbers that you can check to ensure that, management is growing the business and ensuring that this is a business that, one thing is not taking on long-term debt. That's definitely important, but also how they're, investing the cash. Are they, keeping expenses down? Is also important to me. A management team that is really being, it's even just like a normal household. You want them to spend less on expenses than what they earn, but yet we see companies that, are spending more than they actually sell. And that's also a measure. And that should kind of be the first thing that you're doing. But so many people that are buying stocks out there don't even think about something like that. Is this company actually selling more than what they're spending? And I also understand it can be difficult if you're like, you don't know where to look, or you don't know even how to see, do they spend more? But, that people aren't even reflecting on before they buy a company. Did this company have a loss or profit this year or throughout the past couple of years? And how's management team actually spending the money that they get through sales? Yeah, I just think I do understand why, because I've been an investor that did not look at that in earlier in my life. I didn't look at that. I was drawing lines on a chart and doing all kinds of other funny things. But today, where I know it's not about that in the stock market. It's not about drawing lines on a piece of paper, following the graph, and about shoulder formations. It's about, ensuring that it's a healthy business and also using common sense, right? This is common sense. It's common sense. Do they have a profit? It's kind of common sense, but we forget about that. A lot of investors or people that are buying stocks, they just simply forget, what is it that we're trying to do here? What are we dealing with? It's not a stock, it's a business. So, yeah, that's something you can hear. I'm very passionate about this,
Yeah,
Michelle.
you make tremendous points. And like, think about, how do we measure cash flow? Like, Sina, what would be one way to figure that out? If you're like, yeah, that's right, Sina, I want to figure out if this company's even profitable. Like, what would you suggest someone go about thinking about figuring out if this company's profitable or has positive cash flows?
Yeah, but it really depends if you're a numbers person or if you're a more visual person. Like if you're a visual person, I recommend going to a website like Guru Focus. They have like a graphic chart that measures net income, and you can see, is it green? Then, they had a positive net income. If it's red, they had a loss. So that's one of the ways where you can go to Guru Focus. You can see visually which way is it going. They have other numbers on Guru Focus as well. Of course, they have a lot of numbers, and it's overwhelming if you don't know what to look for. But yeah, now look for net income on Guru Focus, and you can see if it's green,
Yeah.
thumbs up, red, thumbs down.
And I think they also have some high level stats. Like you can see, say some of the cash flows might be trending. Like I think they have some high level, say 5 year and 10 year averages that they put in a little box of, say, the earnings growth or the revenue growth. And you can see a few of those types of indicators. And you can also do the number crunching yourself if you want to take the time to go through the 10Ks and 10Qs and pick up the elements that you need to find to be able to calculate what their cash flows look like. So it's doable. And, if you want to get some mentoring on how to do some of that, visit investionista.com and learn from Sina. Or also, there are so many materials out there that you can learn about how to calculate free cash flow and also look for these elements if you need help to identify, net income and where it's meaningful and how to make heads and tails of some of the trends.
For me at least, I live a busy life. I have a family. I used to have a corporate career, so I know what it's like to be busy and not being able to, go through a site like Guru Focus with so many numbers and having no idea where to start, right? So I'm really trying to, and what we're trying to do here is to make it easy accessible. And as you can hear, it's just a small tip. Go to gurufocus.com, look at net income, see if it's going up or going down, it's red or green. It's some of those things that you can easily and quickly do. And where you can, if you just have a few things that you have to look for in order to ensure this is healthy or this is a sickly business, you can actually quickly get started. And what you're going to do is, of course, you want to look even more into that business once you know a few of the key parameters. You can, spend some more time doing that. It doesn't have to be overnight, but it can be, over time that you follow along with the company. So for me, it's important to, with these little tips and tricks on how to do it fast and not making it too complicated. Like I've experienced mentors that makes it extremely complicated and complex, and where even Buffett himself says it needs to be easy. Like don't overdo it, but so many people actually are. You can pretty quickly see it in the numbers.
Yeah, and I think that should bring us to, another point to consider, which is called margin of safety. Now that we're talking about all these numbers and what is margin of safety? Well, it's where you try to buy a stock at a discount to its true intrinsic value. So it's a related concept to discounted cash flow. And if you want to go into learning about all what that means, you can look that up online. Like sometimes sites like Investopedia give you a good example of how you can work through an example of a discounted cash flow analysis. And that can give you a suggested value of what a company might be worth. And there's also Warren Buffett's owner earnings that you can learn from the town's invested book. Like I like how they give you a step-by-step how to calculate owner earnings, and you can use that as part of evaluation formula. So there are ways that you can figure out what can give you a margin of safety to a stock. And sometimes, even though it would be ideal to get a stock at 50% off its true intrinsic value, you don't always get that great of a discount. Sometimes we might have to settle for less, like 20% of a discount to its intrinsic value. So, what you're trying to do is ideally buy a dollar's worth of value for less than that. So, if you can get it at less than the dollar's worth of value, you're doing a lot better than everyday people who might just be just buying something at full price or exceeding its full value price. So, if you think about it like that, you want to try to buy something on sale is the best way to think of margin of safety.
And the reason why we're talking about margin of safety is also because if you made a mistake, you found a stock, you were looking at all the numbers we were talking about, and you kind of built your case on this is a great business, if you made a mistake. And we can all make mistakes, or something can happen in the world that significantly changes this business. When you've bought it at a fantastic price, then you don't risk your money because you've already bought it cheap, and you can most likely exit the stock without losing money, which is so important, right? We've, worked hard, we've earned money, so you don't want to lose your money in the stock market. And that's why, we're investing with this margin for errors in case, we made a mistake when we build our case. The benefit of doing it like that is also that the probability of the stock moving upwards after buying it at this margin of safety, there's a greater probability that it will go up rather than, over the years go down. It might continue to go down, and we can buy more stocks. But over the years, what we'll see is that that trend will change, and then the likelihood of the stock going up, is greater than buying at the top, when the stock is trading at full intrinsic value. Then there's a higher probability that, it could go up or it could go down. We don't know. So that's another way of looking at this margin of safety is, first of all, if you made a mistake, and also looking at the probability of where the stock will move in the future.
Yeah. So yeah, it means that when you mention like you're not risking so much, like if you did your homework and bought it with conviction at a price that is fair and makes sense, you can sleep better at night, and you're not worrying like if you're buying Nvidia at the top of the market maybe nowadays. I don't know how much more it will run, but it could potentially be at the most expensive it's ever been. And there were some people who did the same back in 2000 with Microsoft, and those people had to wait over a decade to get back to break even if they held it that long. So even though these are great companies, they have tremendous value, but if you pay too much of a price for it, you might live to regret it. And that's what you're trying to not end up in that situation by buying something at a margin of safety is you pay a fair price for a wonderful business, which is basically what Warren Buffett and Charlie Munger have taught us is you don't have to pay a wonderful price for a fair business, because if you buy a mediocre business and even if you get it at a great price, it will maybe not perform that well. So you want to flip it a little bit and focus more on paying a fair price, not getting necessarily, I mean, if you can get a wonderful business at dirt cheap, great, that's amazing. But if not, at least pay something that's fair that, like say you're buying something secondhand, what you think is a fair price when you go out there and you're maybe buying a secondhand couch on Facebook Marketplace. You're not just going to give someone $5 for a decent couch. You're going to give them a fair price for the couch. So if you think about it like that, when you're buying stocks, you will try to think more like what is fair for this?
Or just waiting for the, Black Friday sales to buy some really wonderful quality that you've wanted to buy. Like I always, it's, a little bit of a funny story, I know that, but I have this brand of socks that I really like, but I only buy them at a sale. But when those socks go on sale, I buy socks for a year worth of, wear and tear. And that's the same thing you want to do with stocks, buy a lot when they're cheap. And I also thought that you had a great point about Microsoft around year 2000 and how long it actually took investors to get their money back. It must have been absolutely terrible to have, bought on the top, and then many people probably sold, and many people had to wait and wait and wait for actually the stock reaching the price they bought it for on that low point.
Well, I mean, don't feel discouraged. It just is a cautionary tale, like we said, of the value and importance of buying something at a margin of safety price so you can sleep well at night and not just be like, "Oh my god, am I the greater fool?" You don't want to be the greater fool. So, if you heed some of these lessons from some of the best investors like we talked about, Buffett and Munger, hopefully that won't happen to you or us.
Absolutely. That's a great high point to close this episode on. We'll be back in a week from now, so see you on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.